Welcome back to the Deep Dive. Today, we're doing something a little different.
Yeah, a bit of a change of pace.
Normally, we take one company.
Right.
Right. We put it under the microscope, tear it apart, and, try to figure out what really makes it tick. But today, we're doing a comparatives deep dive. We are taking 4 absolute giants of enterprise software ServiceNow, SAP, Workday, and Oracle, and we're putting them all in the ring together.
It's a battle royale of business models. And, this is frankly the most useful way to do this kind of analysis. Looking at a company in isolation can be, it can be dangerous.
Comparison reveals the truth.
Exactly.
Okay, but here's the premise for today. And I want to be really, really clear about this because it frames everything we're about to say.
Right, the ground rules.
The ground rules.
Yeah.
We are not looking at who's going to beat their earnings estimates next quarter. We're not looking at technical charts or, stock momentum. We are adopting a very specific persona today.
Yeah.
Imagine we are 2 disciplined capital allocators. We're in a room just thinking out loud.
Yeah.
And our only goal is to figure out which of these 4 holds the strongest hand for long-term risk-adjusted compounding.
Right. Structural durability. That's the key phrase. If you had to put capital away for, say, 10 years, the old coffee can portfolio idea, which of these engines is the most likely to just keep humming along?
Without exploding.
Without exploding, without needing a huge infusion of external capital, and crucially, without getting disrupted by a new competitor out of nowhere.
So we're trying to strip away all the noise.
All the noise. We're looking at the physics of these businesses.
The physics of the business. I like that. So we have these 4 massive companies. On one hand, you've got the cloud natives, right? ServiceNow and Workday. They're the new guard.
The disruptors.
Then you have the European titan, SAP, which feels like it's been going through this massive kind of painful transition for years now.
A perpetual transition.
And then there's Oracle, the original database king, now trying this huge pivot into infrastructure. It really feels like a clash of eras.
It is. It's a clash of eras, and it's a clash of philosophies. You've got the pure cloud efficiency on one side,
right,
and then you have the legacy transition friction on the other. And I think the central tension of this entire discussion, the hook we need to keep coming back to, is pretty simple.
What's that?
Can the legacy giants, SAP and Oracle, pivot fast enough to defend their turf before the cloud natives, and I'm thinking specifically of ServiceNow here, capture the entire orchestration layer of the enterprise?
That is the multi-billion, maybe trillion-dollar question. Okay, so before we get into the weeds of each company, let's establish our standard, our evaluation standard. The research we're looking at calls this Phase 0.
Yeah, the baseline.
It lays out the criteria for what we consider superior investment quality.
Yeah.
What are the absolute non-negotiables for us?
So if we're putting on that skeptical allocator hat, there's a strict checklist. First, and this is basic, but it has to be said, durable, excess, return on invested capital. ROIC.
Meaning they generate returns way above what their capital costs them.
Way above. But here's the important part. They need to do it without relying on the debt markets to fuel that growth. We are looking for self-funded growth.
So they make enough cash from their own operations to pay for their own expansion. They're not constantly going to the bank to build the next data center in this case.
Precisely. The engine has to produce its own fuel. Second, we need structural switching costs.
Okay, define that.
If a customer wants to leave, it should be operationally painful. I don't just mean because of a legal contract. I mean the product is so embedded, so woven into their daily process that ripping it out would be like operational suicide.
So customers stay because they basically have to.
That's the dream. And then finally, we're applying what the research calls a skeptical filter. We're looking for low single-point fragility. We don't want a business that breaks if one key regulator suddenly gets angry, or if one major partner decides to walk away. We want resilience. Distributed strength, not concentrated weakness.
Okay, that's a great framework. Self-funded, high switching costs, and no single point of failure. Let's open up the hoods of these cars now and look at the engines. We're calling this how the economic engines work.
Let's do it.
Let's start with ServiceNow. When you look at their financials, what do you see? What's the engine look like?
ServiceNow, ticker NNowW, is honestly, it's the cleanest engine in the entire group. It's what you'd call pure sauce economics.
Okay.
Something like 97% of their revenue is subscription-based. That is incredibly high-quality revenue.
So it's predictable. It's not lumpy?
It's not lumpy. They're not chasing those big one-off license deals at the end of the quarter just to make the numbers look good. And because it's software, they have immense operating leverage.
Which means every additional dollar of revenue costs them very little to generate. The marginal cost is almost zero.
Almost zero. And that beautiful reality flows right down to the bottom line. They're running a free cash flow margin of around 35%.
35%. That is a cash-generating machine.
It's incredible. It's asset light, it's scalable, and it creates its own fuel. They do not need to ask Wall Street for money to grow.
So ServiceNow is the Ferrari. It's fast, it's efficient, maybe a bit expensive to buy, but the engine is absolutely pristine.
That's a great analogy.
Okay, what about Workday, ticker WDAY? They're also cloud native. Is it a similar story?
It's very similar in terms of the, let's call it the purity of the model. It's high-quality SaaS. They don't have any of that legacy baggage, the on-premise servers and all that complexity.
Right.
The key distinction with Workday, though, is the scope. Their product, which is mainly human capital management, HCM, and financials, is just a bit narrower than the grand ambition we see with ServiceNow.
So they're more of a specialist.
A very successful specialist. But financially, it's a very clean, very healthy engine. If you like the ServiceNow model, you're probably going to like the Workday model, too.
Okay, now we get to the messy ones.
Mm-hmm.
Let's talk about SAP. I feel like SAP has been transitioning to the cloud for my entire career.
I think for everyone's entire career.
So what does that engine actually look like right now?
SAP is the complex hybrid. The best analogy I've heard is it's like trying to rebuild a gas car into an electric car while you're driving it down the highway at 60 miles an hour.
That sounds stressful.
It is. They have a massive recurring revenue mix, which is great, about 86%. That gives them stability. But, and this is the key, they are suffering from what the analysts call a mix headwind.
Okay, you have to explain that. A mix headwind. Why does moving to the cloud, which sounds like a good thing, hurt them initially?
It's all about the math of the transition. In the old world, SAP sold on-premise software, and with that came these massive support and maintenance contracts. Those support contracts had 90% plus gross margins. It was basically free money, pure, unadulterated profit.
Just flows right to the bottom line.
Directly. Now they're moving those same customers to the cloud, and cloud subscriptions are great, they're recurring, but they have lower gross margins than those old support contracts.
Because they actually have to pay for things now.
Exactly. SAP has to pay for the hosting, the delivery, the operations, the security. So as they move a customer from the old high-margin bucket to the new, slightly lower-margin bucket, their overall profitability takes a temporary hit.
So they're trading $1 of incredibly profitable revenue for $1 of just moderately profitable revenue, with the hope that in the long run, the volume and the growth make up for it.
That is the bet. They have this legacy annuity ballast, that huge, sticky installed base that stabilizes them, but it also slows them down. It's a drag on the engine until this entire transition is finally complete.
Okay. And then there's Oracle. ORCL.
Okay.
Oracle feels like the real outlier in this group.
Oracle is absolutely the outlier. If ServiceNow is the definition of asset light, Oracle is becoming incredibly asset heavy.
By choice.
By choice. They are pivoting their entire business model toward OCI Oracle Cloud Infrastructure. Their goal is to compete head-to-head with Amazon AWS, Microsoft Azure, and Google Cloud.
And building out global cloud infrastructure is not a cheap hobby.
It's one of the most expensive things a company can do. And you see it starkly in the numbers. This is the kind of scary part of the deep dive. Over the trailing 12 months, Oracle has had negative free cash flow of $13.2 billion.
Hold on, say that again. Negative 13 billion with a B.
Negative 13.2 billion. They are burning cash to pour concrete and build data centers. And because they aren't generating nearly enough cash from their operations to fund that spending spree,
They're borrowing.
they're seeing rising leverage. They're borrowing to build. And this creates a fundamental divide in our entire comparison today.
It really does.
You have ServiceNow and Workday, who are capital efficient. Yes, they depend on expansion growth, but they fund it themselves. And then you have Oracle, which is intentionally sacrificing its beautiful asset-light economics to build what is essentially commodity infrastructure.
That is a stark contrast. I mean, on one hand, you have software companies that write code once and can sell it 1 million times for almost no extra cost.
Right.
And on the other, you have Oracle hiring construction crews and buying servers by the truckload. It completely changes the risk profile of the business.
It changes everything, and that leads us perfectly into the next question, which is about durability. Where does the moat actually come from for these companies? If these are the engines, what's the armor plating that protects them?
Let's start with SAP. You called it the fortress.
Yeah.
Why is it so difficult to kill SAP?
The word is embeddedness. If you run a major multinational corporation, think of a BMW, a Coca-Cola, Siemens, SAP is your system of record.
It's the central nervous system.
It's the source of truth. It tracks every single dollar, every pallet of inventory, every customer invoice. It is completely woven into the fabric of how that company operates. Ripping out an ERP system is like trying to do a heart transplant on yourself while you're running a marathon.
It's career suicide for the CIO if it goes wrong.
Total career suicide. And SAP has a catalyst on its side right now. They have maintenance deadlines coming up for their old on-premise software. They're essentially telling their customers, you have to move.
Forcing their hand.
They're forcing migrations to the cloud. And because the switching costs are so astronomically high, because the pain of leaving is so much greater than the pain of upgrading, most customers are just going to grit their teeth and move to SAP's cloud. That is a powerful, if maybe slightly coercive moat.
Coercive moat. I like that term. Even if I wouldn't want to be the customer on the receiving end. Okay, now, compare that fortress to ServiceNow, which we called the glue.
Right. ServiceNow is different. It isn't usually the system of record. They don't hold the canonical data for finance or HR. They manage the workflow. They sit between all the different departments.
So if HR uses Workday, and the sales team uses Salesforce, and finance is on SAP.
ServiceNow is the orchestration layer on top that connects them all. It manages the handoffs. It's the manager of managers, so to speak.
Okay, I see.
And that workflow orchestration layer is very, very sticky because once you build all your unique business processes into the platform, it becomes the institutional memory. It becomes the way work actually gets done.
But there's a catch.
There is, and this is key. The sources we looked at suggest that the competitive overlap for that layer is expanding. Other companies are starting to wake up and say, hey, we can do workflow too.
We'll definitely get to the Microsoft threat later, because that seems like the elephant in the room. What about Oracle's moat? You mentioned they have the database, which has always seemed invincible, but their new cloud moat is weaker.
The database moat is a fortress, very similar to SAP's ERP moat. It's old, it's sticky, it's hard to rip out. But they're betting the entire future of the company on OCI, their cloud infrastructure. And the question you have to ask is, does Oracle really have a moat in cloud infrastructure?
I'm guessing the answer is no.
Not really. It's a commodity business. Amazon has the scale advantage. Microsoft has the distribution advantage with its enterprise customers. Google has the tech and AI advantage. Oracle is entering a three-front war where the only way to win is to spend more money than everyone else. That's not a moat. That's a spending contest.
And what about Workday, the specialist?
Workday is incredibly strong in its niche, human capital management. If you're a large, complex enterprise, chances are you use Workday for your HR functions. They are best in class there. But the sources suggest they're more contestable in the broader enterprise resource planning or ERP space. When they go head-to-head with SAP or Oracle on financials, it's a tougher fight. They're the specialist, which is great for their core market, but it does seem to put a ceiling on their total dominance compared to the sheer breadth of what SAP does.
Okay, so we have the fortress, SAP, the glue, ServiceNow, the database/construction site, Oracle, and the specialist, Workday. Now we need to apply that skeptical filter we talked about at the beginning. Where is the fragility in these moats?
Let's look at SAP's fragility first. It's pretty specific. Regulatory risk. The European Union is, as we speak, investigating their support and pricing practices. Remember those 90% plus margins we talked about on the old support contracts? If the EU comes in and decides that SAP is using its market dominance to force unfair pricing or bundling on customers,
they could crack that moat wide open.
They could. It's a classic single-point failure risk. One regulator's decision could materially change the economics of their business model.
And for Oracle, what's their point of fragility?
It's both financial and strategic. Their moat in cloud infrastructure, as we said, relies on spending money, not on some unique intellectual property. If they stop spending, they fall behind immediately. If they keep spending, they keep burning cash. That is a fundamentally fragile position compared to a company like ServiceNow that runs on code and intellectual capital.
This transitions us perfectly into the next area, which is management and capital allocation. Because if you're investing for the long term, you're not just betting on the product, you're betting on the people making the decisions. How do these teams stack up?
Well, let's start with what seems to be the gold standard in this group, at least according to the research, ServiceNow.
Okay.
Their execution has been praised pretty much across the board. They've managed to do something very difficult, expand their operating margins while still growing the top line very rapidly. They have incredibly strong operating cash flow, over $5.4 billion.
And they're balancing that with buybacks, right?
Yeah.
To offset dilution.
They are. They're doing meaningful share repurchases, and the stated goal is to offset the stock-based compensation, or SBC, that they pay their employees. Now, the sources do note that their SBC is quite high, so they really need to prove they can fully neutralize that dilution over time. But functionally, the decisions they're making look very rational.
Now, contrast that with SAP. You mentioned a trust tax earlier. That sounds ominous.
It's the source of a lot of frustration for the invitor class. SAP has a history of, let's say, changing the goalposts.
Also.
They'll redefine their key performance indicators, their KPIs. They'll make optical adjustments to the numbers to make a transition look smoother than it is. So even if the underlying business is doing better, and right now it is, investors tend to apply a discount because they're always a little bit suspicious. They're wondering, are these numbers real, or is this just a new definition of cloud revenue?
Consistency is currency in capital allocation. If I can't track your progress from year to year because you keep changing the ruler, I'm just going to value you lower.
That's exactly the trust tax.
Okay.
And then we Oracle. And this is a major concern point in the research. The sources flag this as a distinct negative differentiator. It's that debt-funded CapEx surge we talked about.
The credit card bill is coming due.
It is, and it's combined with a governance concentration issue. Oracle is run by a very small, very tight inner circle. When you combine high leverage, negative free cash flow, and a concentrated governance structure, you have to have absolute, unwavering faith that Larry Ellison and the team are right about this OCI bet.
Because if they're wrong,
there are no guardrails. The downside could be severe.
And where does Workday fit in this picture?
Workday is the steady hand, competent, disciplined. But the sources do point out that they're less cycle-tested when it comes to major capital allocation decisions compared to these giants. We haven't seen them navigate a massive global crisis with billions of dollars on the line in the same way we've seen SAP or Oracle have to. But generally, they are viewed as very responsible stewards of capital.
So from a pure allocator's perspective, the preference seems clear. We'd rather own the companies that fund their own growth, ServiceNow and Workday, over the one that's borrowing heavily to build commodity infrastructure, which is Oracle.
It's a pretty clear-cut choice if you're prioritizing balance sheet strength and self-sufficiency. We want self-funding engines.
But the world isn't always sunny skies and 20% growth. We need to do some stress thinking. This is our what-if section. So let's run scenario one, a margin crunch or a major growth slowdown. Yeah. The global economy tanks, IT budgets get slashed across the board. Who survives best?
In a slowdown, the research suggests that Workday actually degrades the most gracefully.
Really? Why them?
Because of the purity of their model. It's pure SaaS. They have no major debt leverage to worry about. If growth slows from 20% to 5%, they can just slow their hiring, cut back on marketing spend, and their margins would likely hold up or could even expand. They don't have a massive fixed cost base like a factory or a data center to pay for no matter what.
So they're number one for downside resilience.
That's how it's framed.
And who's on the flip side of that coin?
Oracle is by far the most fragile in this scenario. If demand for AI and cloud computing slows down, that capital expenditure they've already spent, it's a sunk cost. It's fixed. You can't unbuy a data center. And the leverage, the debt payments, they don't care if your revenue is down. The bank wants its money.
That's a dangerous cocktail in a recession.
A very dangerous cocktail. Falling revenue plus fixed costs plus high debt is how companies get into real trouble.
Okay, scenario two, single point failures. We touched on this with the Moats, but let's go a little deeper. What is the nightmare scenario for ServiceNow?
It's concentration. The deep dive highlights something pretty specific. ServiceNow has an 11% revenue concentration in a single federal channel partner.
Wait, one partner accounts for 11% of their business?
One single relationship. Now, it's a reseller that serves many government agencies, but it's still one contract, one point of contact. If that relationship breaks for political reasons, performance issues, anything, that is an immediate, painful 11% shock to the system. That is a classic single point failure risk.
And for SAP, it's that transition risk we keep coming back to.
Right. We call it backlog durability. Right now, investors are giving SAP a lot of credit for this huge cloud backlog they've built up. They're banking on SAP converting that backlog into future revenue. But what if that EU regulatory action we mentioned weakens their ability to charge the prices they've been charging? What if it limits their ability to bundle products? All of a sudden, their pricing flexibility vanishes. And that backlog might not be worth nearly as much as we all thought it was.
Okay, now I want to spend some real time on this next stress test because it is fascinating and, frankly, a little terrifying.
Yeah.
The sources call it the Microsoft Structural Stress Test.
This is the big one for the cloud natives.
We often hear about the competition for ServiceNow being, BMC or Atlassian's Jira, but the research strongly suggests the real long-term existential threat is Microsoft. And not because Microsoft wants to kill ServiceNow directly.
But because they might just make them irrelevant by accident.
Yeah.
It's the classic threat of good enough bundling. Microsoft doesn't need to launch a product called the ServiceNow killer. They just need to make workflow and automation capabilities good enough inside the tools that you and your company already pay for and use every single day.
Let's break down the attack vectors here. The research points to 3 of them.
Right. First, you have Teams and Microsoft 365. If you're a mid-sized company and all your employees live and breathe in Microsoft Teams and you can build a simple approval workflow right there in a chat channel, why are you going to pay ServiceNow a massive premium for a separate portal to do the same thing?
Good enough is the enemy of best in class.
It always is. The second vector is the Power Platform. This is Microsoft's low-code, no-code automation tool. It's incredibly powerful, and crucially, it's often included in the big enterprise license agreements.
So it's effectively free.
Effectively free, and that puts a hard cap on ServiceNow's pricing power, especially in the mid-market. ServiceNow can't go in and charge a company $1 million for a workflow solution that Microsoft is basically giving away as part of the bundle.
And the third vector, this one feels more futuristic.
This is the long-term sci-fi threat, AI agents. Think about what ServiceNow does at its core. It's a sophisticated if-this-then-that machine. It connects systems. It says, when a support email comes in, create a ticket in this system and assign it to that person.
Okay.
But what happens in a world where an AI agent living on your desktop or in the cloud can just read that email, understand the intent, log into the ERP system directly via an API, and fix the problem itself without any human intervention?
Then you don't need the platform in the middle. You just need the agent.
The orchestration layer becomes event-driven, not platform-driven. The value shifts from the glue that connects the systems to the doer, the AI agent that actually takes the action.
That is a legitimately terrifying long-term threat for ServiceNow's whole value proposition. So what's the defense? Why hasn't Microsoft already crushed them?
Because the enterprise world is incredibly messy and complicated. ServiceNow is safe, for now, in the complex, regulated, multi-department enterprise workflows.
So they go for the hard stuff?
They own the hard stuff. Microsoft disrupts the simple stuff, the I need a new laptop request, but for the I need to onboard a new senior executive across 3 different countries with 4 different compliance checks and then update the global payroll system workflow.
You're still calling ServiceNow.
You're still calling ServiceNow. Microsoft disrupts the low end and the mid-market. ServiceNow defends the high end of the enterprise.
So the risk isn't that ServiceNow just disappears overnight. The risk is that their total addressable market, their growth ceiling, gets lowered because they can't penetrate the mid-market as easily as they thought.
That's it exactly. It becomes a valuation compression story. If you are priced for 25% growth forever, and Microsoft quietly caps your potential at 15%, the stock can get crushed, even if the business is still perfectly healthy.
This brings us perfectly to the big trade-offs. Every investment is a choice, a trade-off. Let's try to categorize these 4 companies along those lines. First up, growth versus stability.
ServiceNow clearly offers high growth. We're talking 20% plus, but it comes with those high expectations and the valuation risk we just discussed.
And on the other side,
SAP offers stability. They have that massive sticky installed base. The revenue is not going to fall off a cliff, but you have to have the patience to stomach that messy, painful, multi-year transition. It's a boring but hard trade.
okay, next trade-off, scale versus innovation.
Oracle is betting everything on scale. They want to be an infrastructure utility provider like the power company, but in doing so, they're arguably losing their innovation premium on the application side of the business.
And Workday.
Workday is kind of the safe but maybe boring middle ground here. They're innovative enough in their niche, they're scalable enough, but because they have that narrower scope, there's just a lower ceiling on their ultimate compounding potential compared to the others.
And finally, a really important one, predictability versus optionality.
ServiceNow has high optionality. They started in IT service management, but now they can move into Legal workflows, creator workflows, customer service workflows, there's a lot of blue sky in their future.
A lot of different paths to growth.
Many paths. SAP, on the other hand, is the definition of predictable. As we've said, people hate changing ERP systems. You know that revenue will be there next year and the year after, but you lack that blue sky upside. You aren't going to wake up one morning and see that SAP has doubled its addressable market overnight.
Okay, we have torn these businesses apart. We've looked at the engines, the moats, the managers, and the nightmares. Now we need to synthesize all of this. Let's step back and look at the margins of difference. Where are the gaps between these companies really wide?
The widest gap, by a country mile, is between ServiceNow and Oracle. It is a fundamental structural difference. One is a capital-light, cash-generating machine. The other has become a capital consumption engine. That is the biggest and clearest divide in this entire group.
And where's the gap the most narrow?
The narrow gap, and this is maybe a bit controversial, is between SAP and ServiceNow.
Interesting. Why?
If, and I have to stress it's a very big if SAP pulls off this cloud transition perfectly over the next few years, their moat might actually prove to be deeper and more durable than ServiceNow's.
Because being the system of record is stickier than being the workflow layer.
Exactly. The system of record is just harder to displace than the workflow layer. But that's a long-term theoretical argument. Right now, today, ServiceNow is executing far better.
So based on all of this, let's talk conviction levels as disciplined allocators.
Okay. For ServiceNow, I'd say moderate to high conviction. It combines the scale, the margin, and the subscription purity you want to see. The only reason it isn't high without qualification is that federal partner concentration risk and the long-term Microsoft threat.
Makes sense. What about SAP?
SAP is moderate conviction. It's a fantastic, durable business, but it's clouded by that messy governance history and the very real execution risk of the transition.
And Oracle.
Oracle is low conviction. It fails our skeptical bar almost entirely due to the capital intensity. We just don't like funding massive construction projects with debt when we can own asset-light software models instead.
And Workday is sort of the safe bronze medalist in this framework.
That's a good way to put it. It's resilient, you feel safe owning it, but it just doesn't seem to have the same alpha potential as ServiceNow or a successfully transitioned SAP.
The source material we've been using actually has a quantitative scoring system. It's phase 4 of the report. How did the final numbers shake out when they tallied everything up?
Yeah, it wasn't particularly close. Based on the criteria of business model, moat, management, and financials, ServiceNow scored 26 points.
Okay. And Oracle.
Oracle scored 11.
Wow. 26 to 11, that's a massive gap.
The difference isn't subtle, it's structural. When you add up all the small and large advantages, ServiceNow wins on almost every single line item in a side-by-side comparison.
So we are reaching the end of our deep dive. We promised a verdict at the start. Based strictly on the deep dives we've analyzed today, how do we rank them for long-term, risk-adjusted compounding?
Okay, here is the final ranking based on the evidence presented. Number 1 is ServiceNow, NOW. It appears to be the strongest risk-adjusted compounder of the group. It has the cleanest engine, the best execution, and a huge runway.
Number 2.
Number 2 is SAP. It's the runner-up. It has arguably the deepest underlying moat, but its final ranking is heavily dependent on flawless execution over the next few years.
Number 3.
Number 3 is Workday, WDAY, the resilient bronze medalist. As we said, you probably won't lose your shirt, but you might not win the race either.
Which leaves number 4.
And number 4 is Oracle, ORCL. It's the weakest link in this analysis. The capital intensity and the rising leverage just make it too fragile for a portfolio focused on quality and durability.
That is a very clear hierarchy. But in the world of investing, there is always one variable that could flip the entire script. What is the single variable that could change this ranking in the future?
It's SAP's cloud backlog resilience. That's the one to watch. If SAP can demonstrate consistently that it can grow that cloud backlog through 2026 without seeing major margin leakage and without the EU regulators destroying their pricing power,
Then what?
then their structural moat, the fortress of the ERP, could eventually be seen by the market as more valuable and more durable than ServiceNow's orchestration moat. If the transition works, the fortress is ultimately stronger than the glue, but they have to prove it.
So ServiceNow is the clear winner today, but SAP is the one to watch for a potential turnaround story.
That's exactly right.
I want to leave our listener with one final thought, something to chew on as they think about this space. We've talked a lot about engines and moats, but let's look at it through a lens of pure functionality.
Okay. In a world being disrupted by AI, you have to ask yourself a very simple question. What part of the enterprise stack do you actually want to own?
Go on.
Do you want to own the plumbing? That's Oracle. It's essential, but it's a commodity battle with huge capital requirements. Do you want to own the record? That's SAP. It's the history of what happened. It's incredibly valuable and sticky. Or do you want to own the nervous system? That's ServiceNow, the thing that senses a change, decides what to do, and acts on it.
The nervous system seems like it would be the most valuable piece of real estate right now.
It does, provided Microsoft doesn't find a way to numb it.
That is the perfect place to leave it. A huge thank you for tuning into this comparative deep dive. I know it's complicated stuff, but hopefully we made the pieces fit together for you.
Always a pleasure to unpack these engines.
Until next time, keep digging.